Anna, the floor here is yours.
Okay, so hello everyone, and welcome to the Accounting Design Project. My name is Anna Michkovic. I'm an assistant professor at the University of Amsterdam, and I will be moderating today's session. It's a pleasure to introduce our speaker, Natalie Berfeld, who is an assistant professor at Boston College. And today she will present her paper, Is Beauty in the Eye of the Beholder? Do fair value estimates depend on whether you're the issuer or the investor in debt securities? And before we get started, just a few quick reminders. So please keep your microphone muted unless you're speaking, so that we avoid any background noise. But if you can, please turn on your camera because it helps us to have to make the session more interactive. Also, the first and last 5 minutes of Natalie's talk are uninterrupted so that she can introduce and conclude her presentation. And during the rest of the talk, you're very welcome to ask any questions that you might have. And please raise your hand either using Zoom or type your question in the chat, and I will keep an eye on that and will call you in the order that the questions are coming in. And with that, I'm happy to hand it over to Natalie.
Thank you, Anna. Thank you. All right. Okay. So as Anna said, I am Natalie Berfeld. I'm an assistant professor at Boston College. And today I am presenting joint work with Ki-Soon Choi, Olga Svetsky, and Joe Weber. Before I start, I just want to say thank you to all of you for being here, and thank you to the organizers for this opportunity to get feedback on this paper. And thank you to Anna for saying this mouthful of a title for me, so I don't have to do it myself, and I can get right into the meat of the paper. So in this paper, okay, there we go. Okay, so we study the fair value estimation practices of issuers of fixed income securities. So when I'm talking about issuers, I mean firms that issue fixed income securities, so they hold those securities on the liability side of their balance sheet. And we do so by comparing them to the fair value estimation practices of holders, or I'll also use the word investors interchangeably. And in the context of the paper, we are considering mutual funds and insurance companies. So before I kind of go any further, I just want to put up the definition of fair value according to FASB, just so we're all on the same page. FASB says that fair value is the price that would be received to sell an asset or pay to transfer a liability in an orderly market transaction. So essentially, people refer to this as the exit price or the market-based price. So the motivation for the paper is that there is substantial disagreement about the costs and benefits of including fair value in financial statements, especially when it comes to fair valuing liabilities. The basic trade-off here is that including more market-based information can be helpful to investors in providing more timely information, as opposed to historical costs that can often be based on prices that of prices associated with transactions a long time ago. But of course, requiring kind of more market-based inputs and market-based prices, especially in the case where markets are not particularly liquid, can introduce more of a role for discretion, managerial discretion, and all the issues that come along with that. So regarding prior research, research mostly looks at fair value of assets, in particular in the context of banks, and mostly finds some evidence that fair value does seem to be value relevant over and above historical cost, at least in some circumstances. But in terms of the liabilities fair value, there's less research, but the research that there is concentrates on looking at whether investors or equity holders react or correctly interpret differences in kind of fair value of liabilities, which at first glance can appear to be a little bit counterintuitive. But in this paper, we kind of take a step back and we think about how do fair value estimation choices arise in practice and what are some of the economic forces that kind of shape the estimation decisions. And so just very broadly, what we do in the paper is we, using a hand-collected sample, we compare the fair value that issuers, so again, the liability side, assigns to securities with the value that investors assign to those same securities. So importantly, we keep the security constant. So for the same security in the same year, we try to understand how estimation practices differ between issuers and holders. So these are our kind of three main research questions. The first is we just ask, do issuers and asset holders or investors systematically differ in how they value the same securities? If there are these differences, then we try to understand why they exist. And we also think about some of the consequences of these differences in the market. And so just as a preview of our findings, in terms of the first question, we find that the answer seems to be yes. So issuers and investors systematically differ in how they value these securities. So issuers tend to be at the extremes of the distribution of fair values given to the same security in the same year. We then try to understand what is driving these differences, and we kind of try kind of a number of different hypotheses, which I'm going to share with you in a little bit, but kind of the conclusion to all of that is we find the most evidence suggesting that kind of liquidity is in the eye of the beholder, to kind of a call back to the title of our paper, but essentially that issuers and holders tend to systematically view liquidity differently. And then that is kind of driving the differences in valuations. And regarding the consequences, we find that issuers that have higher valuations compared to the investors that they're facing in the public markets will tend to go to private markets to issue subsequent debt. So just to kind of set the stage of what we're talking about here, and to make it easier to understand what we did, I'm going to just spend a little bit of time talking about the accounting for fair value and what that looks like on the liability and the asset side. So FASB does have a requirement that firms have to disclose the fair value of financial assets and liabilities that they hold. On the liability side, firms do have the option to recognize the fair value as well. So hold them on the balance sheet at fair value. But in practice, non-financial firms essentially do not do this. So they only disclose. But on the asset side, the accounting treatment kind of depends on which investor we're talking about. So for mutual funds, they mark to market. So they recognize everything at fair value, and any changes in fair value flow through net income. Whereas insurance companies, I would say they're a bit more heterogeneous in how they apply and how they kind of treat their securities. But I can say it kind of depends on the insurance company type and the security type, but most broadly, public insurance companies tend to recognize at fair value, but flow changes through OCI or other comprehensive income. So I guess the main point here is twofold. First, there's variation in kind of the accounting treatment of these securities by the different entities that we're considering, which I will kind of come back to. We're going to use this in one of our tests. But then the second point here is that there are these disclosures. And so we are going to take advantage of these disclosures in order to get our data, essentially. And so let me just go through. So in order to understand how we collected the data, I'm going to just walk through a brief example. So I'm going to consider the case of Netflix. So Netflix is a firm that issues public debt. And so in their 10K, they have a footnote. So this is the footnote from their 2019 10K statement. In the long-term debt footnote, they disclose that they've got this 5.375% senior note that was issued in 2013 and it's due in 2021. And they show that the principal amount for this note is $500 million. And for this amount, as of December 31st, 2019, Netflix assigns a fair value of $518 million to that amount of debt. And so we standardize the fair value per $1,000 par. And so we get that on the liability side, the fair value of this bond is $1,036. So that's standardized per $1,000. Okay. Questions? No questions. Okay. So we've got this on the liability side, but now we're going to take the CUSIP of this bond and we're going to look at what the mutual funds assign to, like what value the mutual funds assign and what value the insurance companies assign. So for the mutual funds, for this CUSIP, we go to their Form N-Port disclosures where they disclose the fair value that they assign to each security that they own. And we basically get a list of all of the mutual funds that own this Netflix bond and the fair value, again, standardized, that they assign to it. And we do the same thing for insurance companies. We look in their statutory disclosures where they also have to report this information. And so we get a list of the insurance companies that hold this bond and the fair value that they assign to that bond. And so the basic idea here is that we're going to compare what Netflix does with what the holders of the Netflix bond do. And so just eyeballing this, right, we can see that Netflix, the Netflix bond is, Netflix seems to assign a higher value to the bond than, at least this sample of holders that I have here. And so the first thing we ask is this systematic in the data? Is this just true for Netflix or not? And so in the first research question, to answer this, we collect data on 1,434 other issuer security years, just like the one that I just showed, over a 3-year period. We end up with just over 54,000 mutual fund security years and just over 22,000 insurance company security years. And one thing that I should note, kind of for full disclosure, we do require disclosure on the liability side at the security level. So like the example I showed you with Netflix, they actually list the fair value for each bond that they issue. They don't have to do this. The FASB requirement is just to report the fair value, but they don't have to split it up. So we do kind of select on issuers with relatively better disclosure quality, at least for the issuers that have more than one bond. There are some issuers that only have one bond, and then we don't need this requirement.
Yeah. Natalie, there is a question from Ayung.
Hi, Natalie.
Hi.
So those are the issuer security years, but do you know what's the number of distinct issuers or mutual funds or insurance companies just at an entity level?
Yeah, so it's about 600 issuers. Okay. I don't know the number of mutual funds and insurance companies off the top of my head. Yeah.
Okay. So if it's 600, that means that they probably don't, across 3 years, they don't always have observations across.
Yeah, because there's certain other requirements that we require for the data. For example, we want there to be at least 3 holders for every security to be able to kind of say something meaningful. And we also kind of to prevent data errors, because we are, we're doing this hand collection, so we want to be a little bit more conservative. So we remove observation where there's a lot of difference between the fair values, over 5%. So we don't consider those as well,
Okay.
just to kind of remain conservative. Yeah.
So the reason I ask about the entity level statistics is, in addition to liquidity, have you thought about asset liability matching at the entity level? So some of the financial institutions, that's their business model, is that they want to lend money at a higher interest rate and then borrow at a lower rate. And that seems to be consistent with what you observe systematically on the liability side. They want lower rate interest rates or higher valuation, and asset side will be higher interest rate, lower valuation. So I think for fair value options, according to the standards, to giving those institutions who actually want to match the rate to actually calculate the net profit out of the interest rate arbitrage, to be able to match both sides on the same market-based rate instead of like based on different vintages of interest rate.
Yeah, that's a good point. So we haven't thought of it only because we don't have a lot of financial firms in our data. Most of our issuers are non-financial. But we might want to think about that, at least kind of split, because it's true that the financial firms are more likely to actually hold at fair value. So they're different,
Yeah.
kind of like they're quite different, which is why we kind of concentrated. We tried to move away from them, but it's an interesting point that there might be something else or different or related that we can do with that.
Because for a lot of non-financial firms today, they hold a lot of cash and they have a lot of short-term and long-term investments in financial instruments. And that potentially is what they try to do, is to match both sides by upping into the fair value option. Yep. So you can
Thank
take a
you.
look at their investment sides from the outside of the balance sheet. Yeah, they also disclose, right? But like it's more aggregated. It's not security level. It's all asset class level data. Yeah.
Yeah, but there's something we can maybe do with, like, at least cross-sectionally or something. Yeah. Thank you.
So the next question is from Wakar.
Hi, Natalie. I just had two observations. So I had collected a lot of data on fixed rate bonds issued by non-financial as well as banks. And a recurring theme that I see is whenever they have a fixed coupon bond as a liability, and yes, they disclose in footnotes their fair value, immediately below they tell readers that they are protecting economically themselves by issuing an interest rate swap as well to protect the value of the bond on the liability side. So whenever interest rates go down, which has been the case for the majority of the periods before the interest rate hike, the economic value of the bond is stabilized in the sense they get to better achieve that interest payment whenever interest rates go down because they have a fixed rate. So they end up making a little bit of benefit from it. In technical terms, we call this fair value hedging, but I think that has a role to play because I see this happening in majority of large sophisticated issuers where they couple the debt issued with a swap and they show it in the same footnote. And then obviously that affects the present valuation of the bond because now they will manage the repricing risk. So just was wondering if that has a role to play in the dynamics that you're observing.
That's really interesting. Thank you for sharing that. We have not considered the role of hedging, but I think our results speak to kind of different views of liquidity, which I think might be related, depending on the type of hedging that they're implementing. So I think that that's an interesting angle to explore. So I think thank you for that suggestion.
Peter also has a question.
Yes, hello. Thanks for the introduction to your paper, Natalie. Just a quick question. When you're comparing issuers and asset owners, or asset portfolio holdings, and the valuations on the two sides of the market, do you understand from what does the fair value standards say about the transactions costs? So the Netflix issues the bond. If it's valuing it from the perspective of what will it take to extinguish the liability, then it's going to have to buy the bonds back. On the other hand, the mutual fund is going to receive the other side, the price on the other side of the market. It's going to have to sell the bonds. So where does the spread come into any difference between the two sides of the market when you're comparing issuer and investor? And then if there are differences across issuers, to what extent does do differences in the spread get in the way of your analysis?
Yeah, so let me see if okay, so yes, regarding the standard kind of says that when the issuer tries, when the issuer fair values the security, they need to take into account the values that investors kind of have. So in a liquid market, that would suggest the market price, because that's kind of the aggregation of investor prices. Regarding transaction costs specifically, yeah, I think that I think it's an interesting point to get at. I'm trying to think how we could get at it, but perhaps there is some cross-sectional variation that we could take advantage of.
I mean, my point is that there is not a single market price. You can think of there being a mid-market price at which basically nobody can trade, or, one of the two sides of the spread will be a feasible price for either party to trade at. So it might be interesting to at least control, if you don't already do so, for the magnitude of the spread in any subsequent analysis you do when comparing valuations across issuers.
Okay, yeah, that's helpful. So I guess two things. The first is that I think our results around liquidity are kind of related to this, but we don't couch them. We don't kind of put them in those terms, and maybe we should. And then regarding the second point, we do, so in most of our analysis, we do things with security year fixed effects. So the idea is within a security year, so kind of controlling for all of the characteristics of a given security at a given point in time. How do the issuers, how does the issuer valuation differ from the holders? But
that might fix it. Yeah, I'm sorry I didn't get a chance to read your paper.
Oh, no, that's all right, and I haven't gotten to it, so I'll get to it just in a few slides. Yeah, thank you. Yes, Ayan.
So Natalie, I'm going to help you out here since I just taught fair value accounting 2 weeks ago. So according to SFAS 157, firms need to consider transaction costs when they choose the most advantageous market, but for fair value itself, they should not consider any transaction cost. And according to the basis for conclusion back then, is some of the board members think that transaction costs are not an attribute of an asset or a liability. So somehow, they just decided transaction costs cannot be included in the fair value itself.
Yes, thank you. Yes, it's true. The reason I kind of hesitate to go there, because I think that there's kind of a disagreement about, I know the standard says they shouldn't include it. It's not clear whether they actually don't or do.
Yeah. Well, whether they actually, how do they implement it? Yeah.
Thank you. Okay. All right. So let me keep going here. So after we collect this security year level data, we proceed first by just looking at some univariate statistics. So the first thing we do is we compare the propensity of the issuer to be at the maximum of the distribution of fair values that the distribution of the fair values that are given to that specific security year. So how often are they at the max and at the min? And we find, at 19.2% of the time, or the issuer is at the max 19.2% of the time, and at the min 20.2% of the time. And comparing that to kind of an average random chance, the difference is very stark. When I say random chance, the way we calculate this is basically 1/1 plus the number of holders. So if you imagine this Netflix bond has 19 holders that hold it, then the random chance that Netflix will be at the top of the distribution or at the bottom is 5%. And so kind of just this kind of very crude statistic drives home the point that they're about just over 5 times more likely to be at the extremes of the distribution compared to random chance. We also compare issuers to investors in a univariate sense, and we find that issuers are much more likely than an investor to be at the max and at the min. Again, statistically significant. And then we kind of do the same thing in regression form, but what we do here is we really try to control for those security year fixed effects, which we hope strengthen our design. So what we basically do is we take the valuations that issuers give to securities and we stack them with the valuations that mutual funds give and the valuations that insurance companies give in a single panel. And we create this max value and min value indicator variables. So max value is an indicator that's one if appraiser A is at the maximum for security S at time T, and similarly for min value. And so that's our dependent variable. And then our independent variable is basically just an indicator for being an issuer. And again, like I said, we have those security year fixed effects that help us really try to hone in on comparing issuers to holders for a given security at a given time. So kind of for the same stream of cash flows, the same maturity, the same coupon, everything's the same about the security year itself, about the security itself in the given year. How do issuers compare to non-issuers or holders or investors? And so what we find is that issuers are 10% or about 10% more likely to be at the maximum of the distribution of fair values for a given security year. And for min value, we find kind of statistically and economically weaker results. And that result actually is not very robust. It goes away in some specifications, as I will show you in just a few tables. And so we kind of really concentrate on this max value result, which seems to be quite robust and interesting. So basically the idea is, okay, the issuer seems to be more likely to be at the extreme of the distribution, and sort of why is that? And so the next research question we spend thinking about what could explain this, this result. Okay, so the first kind of thought we had is maybe it's the accounting differences that are driving this. So issuers, like I said, they just disclose their valuations in footnotes, whereas mutual funds recognize changes in the income statement. And prior research does suggest that, recognized amounts seem to have more effect than disclosed amounts to investors. So to the extent that this difference changes the incentives of the appraisers, that might kind of drive the difference in fair value estimation practices. And so to get at this, we, question?
Yeah.
Just it's a random thought in my mind. I apologize for not having read the paper very carefully at the back end.
Okay.
But from the front end, I just had in mind that's if there's a bond in issue and then you have in footnote terms a higher value, then the sort of inference would be that, hey, the spread on it would be low for it to equal that higher values. So is the issuer concerned about its cost of debt as an incentive to make this disclosure?
Do you mean like later on when they go and issue more debt?
Yeah. So they have a lower spread inferred from this value. If it's a publicly traded bond, then the value which is giving the lowest spread is chosen. And that would have a knock-on effect on its WACC, on its other risk-related discount rates and things, because now the cost of debt is low. So the investments would seem profitable and the value of the firm would be higher. So I think these just running incentives coming into my mind that why would they want to show a value higher? Could it be cost of debt related incentives?
Yeah, so something we do to get a little bit at this question is in our third research question, and I'll get to it in a little bit, but we kind of look at the consequences, like what's happening. Is there any effect in the market for this? And so one of the things we thought is maybe there is some strategic disclosure going on where they're trying to influence the debt that they get, but we don't find evidence of that. And we did look at kind of market reactions around these disclosures, and we didn't find a lot of reactions there. So that leads us to believe that there isn't this kind of strategic disclosure angle, but if there's kind of other things that we can look at, I'd be happy to do that. Yeah. Yes, Ken.
Yes. With regard to the framing of this result, have you considered the idea here that, I mean, the issuers probably have better information about the value of the issue of debt that they have been making. And then it would be fairly natural that the issuers would be at the extremes because they have better information about the precise value of the debt that they have issued. And the investors, they are not so informed. So they go to more towards the average. I mean, if you don't know anything, you guess at the average. So the investors would then be inclined to be more towards the center, while the issuers who have better information about the correct value of this issue of debt would be more at the extremes. Have you thought about that framing? I mean, it's fairly natural in a sense.
Yeah, so we have thought about it. One of the things we struggled with is that, well, there's a number of things, but the result does seem to be more on the max rather than the min, and we weren't sure how private information would why would it systematically be kind of overstating. One thing we thought of is maybe, like managers of companies tend to just be optimistic, like that, they just have optimism about their companies. So where we're going to take this, and I don't have the results to share yet, but kind of we're going through a major revision right now, and we are, one of the things we're doing is rather than comparing the issuers to the investors, or I should say, in addition to comparing the issuers to the investors, we also need some kind of benchmark. And so we use the benchmark of the last price, the last observable price, whenever that was. And sometimes it's like a very long time ago, but just to have a benchmark. And actually what we find interestingly is that, it's not that issuers tend to be systematically over the last price, which is what we would expect if they're always optimistic. So we don't have all these results kind of tabulated and thought through yet, but yeah, we are thinking about this and thinking about how to find a benchmark. Another possibility is using like the next price as potentially, like, are they kind of, if they're overly optimistic, they should be farther from the next price than the people who kind of are more realistic. So that's another potential thing we can.
Yeah, I mean, typically there's not, when you look at empirical data, there's typically not just one reason for the results that you see. There are typically many complementary and reasons for what you see. And I believe like Vakar said here, I mean, there might be this kind of extremes first, but then there might be an inclination to go for higher values, which might have to do with low cost of capital and opportunities to issue debt at good conditions in the future.
Right.
So I
Yeah.
think that those two reasons would take you some way here, at least in the formation of the hypothesis.
Okay. Yeah, this is helpful. Yeah. So when I get to it sort of at the end, hopefully I have time, but we do have tests about future, like subsequent debt issuances. And it doesn't seem like that was kind of our actually initial thought is, what if they're kind of they're thinking they're going to issue debt and then trying to kind of change their disclosure based on that future debt issuance, but it doesn't seem to be the case. But I will share those results in just a little bit. Yeah, thank you.
Peter also put an explanation in the chat. I don't know, Peter, do you want to comment on it?
Well, not really. I think there's a link there to a KPMG comparison between US GAAP and IFRS. It does seem that there's an option there to use bid or ask prices other than the sort of mid-market price. So I don't really want to repeat what I said before. It could be worth trying to control for these liquidity-related measures, which capture sort of information uncertainty really about the issuer.
Okay, thank you. Okay, so as I was saying, so to get at this idea of accounting, like do the accounting differences, the disclosure versus the recognition, do they drive the results? We take advantage of this second kind of type of holder that we have, which is the insurance companies. And like I said, they're a little more heterogeneous. Sometimes they disclose, sometimes they recognize, but when they recognize, the changes flow through OCI, not net income. And so the idea is that if this difference in recognition is the main driver, then the effect should be starkest or the results should be strongest when we compare issuers just to mutual funds. And so this is what we do. We rerun our, again, security year fixed effect model, but just with a stacked sample of just the issuers and the mutual funds in panel A here, and then just the issuers and the insurance company separately in panel B. And so overall, what we find is that the effect that we found before, which is that issuers tend to be, are more likely to be at the maximum of the distribution, holds across both, like, so holds compared to both types of investors. But it does seem like the result is stronger compared to insurance companies, which suggests that the differences in accounting do not, at least they don't, this is not the main thing that's driving these results. And so the next thing we consider is, could it be different valuation techniques? So FASB requires the prioritization of these inputs, right? So in addition to the estimates of fair value, firms also have to categorize each security into levels, like level 1, 2, or 3, depending on the observability of the inputs used to create this fair value. So level 1 are essentially securities where there's quoted prices in active markets for identical securities. And these, in this case, essentially the idea is that you should use the unadjusted market price if it's available. If this is not available, then in level 2, you can use quoted prices for similar securities in active markets, inactive markets, or other observable inputs. And then level 3 is really the most opaque, unobservable, and also the least prioritized. So if level 1 is not available and level 2 is not available, then you kind of just create a model in level 3. So the idea that we had is if issuers and holders systematically differ in these levels that they assign to the securities, that could potentially drive the differences in fair value estimates. And so to get at this idea, we collected data on the level that they assign, not just the estimate itself. And we found some pretty stark results, at least we think so. Interestingly, 18.9% of issuers classify these securities as level 1. 7.4% of insurance companies do, and 0 mutual funds classifies level 1. So mutual funds just do not use level 1 as a classification. And so we think that that suggests that there's disagreement on whether level 1 is appropriate, given this kind of prioritization that FASB says that has to be done. There seems to be some disagreement on this. And so that suggests that there might be different views of what constitutes a liquid market in these markets, in these fixed income securities. And so, this is a univariate result, but it holds up to a regression with, all our fixed effect structure and everything else, because this is a pretty strong result. So to kind of get at this idea of, okay, is it something about the way that these firms view liquidity? We create this, we run this model where the dependent variables, so again, we're stacking issuers and insurance companies in a panel, the valuations of issuers and insurance companies. We don't use mutual funds because they just don't ever assign level 1. And our dependent variable here is an indicator for assigning level 1 to a security. And then what we do is we interact the indicator for issuer with market-based measures of liquidity. And so in this table, in each column, we have different market-based liquidity measures. Question?
Deanne, go ahead.
Sorry, I think it's by mistake, sorry.
Oh, no worries. So so the market-based measures of liquidity. So we have 3 measures. So in the first column, we use the log volume, which is just the log of the daily volume in the 3 trading days before the valuation date. The second is price observability. So that's an indicator that's equal to 1 if there's an observable price in the 3 days before the valuation date. And then the third proxy here is a natural log of the number of holders that we have holding that security in our data. And so, whoops, sorry about this. Okay, here we go. So broadly, we find that with increased liquidity or with increased, well, based on those market measures of liquidity, the disagreement regarding whether level 1 is appropriate seems to increase, which kind of suggested to us that issuers seem to weigh liquidity more heavily or more strongly when considering level 1 than do investors. And so we thought this was an interesting finding in that it shows that there's disagreement on whether, how important or the importance that should be placed on the liquidity of a security when deciding on level 1. But what we're doing here is we're trying to see, does this actually explain the differences in fair value estimations? And to do that, we rerun our main tests, but we split the sample and we consider separately the sample of securities that where the issuer has issued level 1 versus a sample of securities where the issuer did not issue level 1. And we, surprisingly, at least to us, we did not find that there's a difference there. So the result that issuers are more likely to be at the maximum of the distribution holds for those securities that were assigned level 1 by the issuer and for securities that do not get assigned. So that's columns 1 and 2. And then in column 3, we basically just stack the design together and use an interaction, but the conclusion is the same. Essentially, even though we do find that there's disagreement on the levels and that issuers weigh liquidity more heavily, we don't find that this disagreement in levels affects or drives the result that we found. Yes, Ayan.
So Natalie, this table 7, you give us issuers and also the interactive term. How about the previous table? When you also only showed us the interactive term, but we wonder that
Oh,
what's the
okay.
coefficient for issuer relative to insurance companies? Or alternatively, you can run a regression with only issuers. Because I think there are multiple things are flowing around, and the interaction term only capture that incremental amount when you, relative
Yes.
to the unreported basis, right?
Yes, yes. So it is in the paper. I just removed it to kind of like fit everything on one slide. But basically, because liquidity is it's not indicator, it's a continuous variable. So
yeah.
the main effect is kind of hard to interpret. For price observability, that's not true though, because price observability is an indicator, and issuer there is positive and significant as before. So yeah, thanks for noticing that. Yeah. Maybe I could have like lowered the size of the text, but then included that. Yeah, thank you. Okay, yeah, and here the coefficients are interpretable because issuer level 1 is an indicator. Yeah, Peter?
I'm just interested to understand why, so the source of the investor valuations is from periodic reporting by the mutual fund or by the insurance company, correct?
That's right, yeah.
So why do users of financial statements, do they really care about the valuations of the individual securities? I mean, if I'm investing in a mutual fund, I'm interested in the fair value of the fund assets at the quarter end, say, or the fiscal year end, aren't I? And it's a basket of securities whose valuation I'm interested in. So do you think that there's much attention given to the reliability of the individual asset valuations within the investor financial statements or notes?
Yeah, that's a fair question. I guess it's a twofold question. So the first is sort of who cares about these kind of security level disclosures? And I think that the reason they're required for the holders is for regulatory purposes. So the regulators might care. The other question is sort of, okay, there's like so many securities. Is it likely they go through each one kind of with a fine-tooth comb? I don't know. Maybe it's not realistic to think that they.
I would suspect that they'll go to the broker and say value the basket. At the the portfolio that they hold at the period end. Now, and then, of course, there's a question of how do the values come from the value of the basket.
So at least in the case of the insurance regulator, I know that they do care about specific securities because of the risk profile of each security and thinking about capital. Insurance companies, they have to kind of hold a certain amount of capital, and if a security is particularly risky, it could go into one tier of capital but not another tier of capital. So for that reason, I think regulators care.
So that would be that's an interesting dimension, isn't it? Because the capital requirements vary between, well, the costs of holding the capital increase dramatically when they become speculative grade, for example.
Exactly. Yeah. That's right. And
I guess you're controlling. I guess you've got the security level, security year, fixed effects, which to an approximation is going to control for credit risk. Yeah.
That's right. Yeah.
Okay, thank you.
Yep. Thank you. Okay. So let me move on to the third explanation that's kind of based on what we just found, which is that there does seem to be disagreement on liquidity, when assigning level, deciding between level 1 and not level 1. And the question that we think of is, okay, if the issuers weigh liquidity more heavily when assigning level 1, could it be that they also weigh it differently when assigning fair values? And in other words, kind of, if the issuers do not worry about illiquidity as much as holders, that is, they don't assign this illiquidity discount the way holders do, then that could potentially explain our results. And in table 9, we basically do a similar test as what we did with level 1, except we use the dependent variable of this max value indicator that we had before, and we interact the issuer with liquidity measures, as the 3 liquidity measures that I introduced before. And we do seem to find that the result, and I again did not include the issuer main effect, I apologize, but it's positive and significant, and then the result attenuates when there's more liquidity. So essentially, issuers are more likely to be at the max when there is more illiquidity, which suggests that perhaps there's a role for this differences in thinking about how liquidity comes into the estimation of fair values. Yes.
So Natalie, I was typing it, but since this model, should we also include liquidity alone as a separate variable?
Liquidity, I should have mentioned it. Thank you for bringing that. Liquidity is subsumed by the security year fixed effects.
Oh, okay. Okay.
Okay, so then
how is liquidity measured? Say with the volume, sorry to interject.
Yeah, so volume is the natural log of the daily trading volume for the 3 days before the valuation date. Price observability is an indicator for if there is a price in the 3 days before. And then the log number of investors is the natural log of the number of holders, so mutual funds and insurance companies, that we have in our data.
So you're using trace data for the
Yes. Yeah.
for the bond
for the
bond liquidity.
Yes.
3 days is a pretty narrow window for bonds. Right?
Yeah, so we didn't know what number to use. We did 1, 3, and 5, and they all seemed similar, so we just picked 3. But if you have thoughts about, should we go far, like longer out?
Sometimes there are only a couple of trades in a month.
Yeah.
Yeah.
Right. Well, that's kind of the point here, is that these markets are illiquid. Yeah.
So let me to confirm, you use either 3 days or 5 days right before the variation day, but like somehow that variable across all the issuance are subsumed by the security year, meaning that in your sample, there's no issuance, more than one issuance within 1 calendar year. Is that right?
Oh,
Because your dependent variable is actually a kind of a more like an event window kind of, it's like right before your valuation day, there are 3 or 5 days prior to that valuation day is how you measure liquidity. But you say you are not able to include that in the regression is because it's subsumed by security year. So there's no more than one issuance for a single security in a given calendar year.
there's no variation in the liquidity measure for a single
Oh.
security year. Yeah, because it's at the
In that
security
case,
year
then
level.
it doesn't matter if the 3 days or 5 days, it's the same as like 365 days, given how infrequent the little temporal variation within 1 calendar year, right? And the number of days you want to measure your liquidity doesn't really matter because essentially that is just a security year dummy effect.
Well, I guess the point is, if there's a security that may be traded 4 days before the market, then we wouldn't kind of, I guess, capture that in the liquidity variable. So it's kind of like how far back do I go to measure liquidity? And because these bonds are quite illiquid, And that actually goes back, I mean, I'm kind of, that goes to kind of our conclusion, which is what is an active market? Like the FASB kind of talks about like these levels, they're all about kind of, is there an active market? Is there not an active market? And really the question here is there seems to be disagreement about what an active market means. And this conversation actually kind of also shows that there's kind of disagreement. It's not clear what is actually an active market. Yes.
Can I ask a quick question? I'm sorry, I joined late. It's a very interesting paper. So do you think issuers are being strategic in doing this? And I guess a related question is, I browsed your paper, I couldn't find it. What is the average overvaluation? Let's say, you know, the insurers and the mutual funds are the ones who are not being strategic. So what is on average, how much is the overvaluation by the issuers?
Yeah, I don't think we have that in our descriptive, so we should add that. Thank you. I don't have that off the top of my head. And then about the strategic nature, we actually we're very interested in the strategic nature of the disclosure. And so we looked at the first thing we looked at is the market reactions, like is the market reacting to these disclosures? And we didn't find robust evidence that there were market reactions. And then when we looked at, and maybe this is a good segue to kind of the next research question, which is, what are the consequences? So we looked at, you know, given that there's these disagreements, how do issuers respond? And one of the responses could be that they try to kind of disclose their point of view and try to influence the market. If they can do so through disclosure, then they could maybe try to influence the market's perception of their debt. But alternatively, if the market, which we found like no market reaction, and there's kind of reasons to believe maybe the market isn't finding these disclosures very credible, then the strategic part of it is maybe less, less there. And then maybe alternatively, as we say here on the slide, they could go, instead of kind of trying to influence the debt market, the public market to see it in the kind of in their view, they can go to private markets. And so what
Natalie,
do we do?
just to let you know, we have approximately 3 minutes left.
Okay, that's fine. I'm on my last test, so that's good. Yes, thank you. So what we do here is we aggregate to the issuer year level, and we have this dependent variable, which is an indicator. It's for issuance in the next year. And in column 1, this is a public issuance on the public markets, and in column 2, it's private debt. So basically, we've got we do it once for public issuance and once for private issuance. The overstate score, the X variable here, is essentially the extent to which the investor is valuing their debt. Sorry, the issuer is valuing their debt over the investors. We aggregate it over all securities of a given issuer, because this is at the issuer level. And so what we're seeing is that those issuers that tend to be more kind of value their debt more highly than the investors, they don't go to the public markets for their next debt issuance, and instead they go to the private. They go the private route instead. Okay. Oh yes, so I have some notes here. Oh yes, we find the effect is concentrated in issuers in more thinly traded markets. And so the evidence doesn't seem to be consistent with strategic disclosure to influence markets, but more consistent with kind of just going to the private debt channel. Okay, so I'm on my concluding slide. So we, in this paper, we consider factors affecting fair value disclosures regarding liabilities. By comparing issuers and holders for the same security year, we find that issuers systematically assign higher values, especially in illiquid markets. And we think that this is important because one of the more concerning elements of fair value in accounting happens when there are no readily quoted market prices, essentially, or when there's a lot of illiquidity. And if issuers tend to view liquidity different than holders in a systematic way, when there are kind of liquidity events or liquidity shocks, it could have some implications to market freezing, as we saw in, for example, the financial crisis. And as I already alluded to, but we hope to highlight the gap between standards and practice in fair value determination. So, FASB says that issuers must consider the fair value of holders when they value their securities. But it's, what if when the market is illiquid, it's not clear what is the mechanism for actually doing this. And moreover, what is an active market? There's kind of disagreement. There can be a lot of disagreement about what an active market is, and that can have effects on valuations. So this is all I've got. Thank you very much for all the comments. Really helpful, and really appreciate your time. And then I do have a little note for the next presentation is going to be May 14th, Wednesday at 5 p.m. And please note that it's a different time and is it a day and time, I think, because of the presenter schedule. So the presenter is going to be Tomomi Takada, and the paper is R&D Accounting and Innovation Signaling. So thank you very much. And yeah, I'll stick around for a few minutes if anyone wants to chat. Thank you.
Thank you.